Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is John Kaiser, founder of Kaiser Research, available online at kaiserresearch.com. He's speaking to us from San Francisco. John, welcome back to This Week in Money.
Jim, it's a pleasure to be back on the show.
You've just come back from London at the Minds and Money conference. What kind of mood did they have there?
Well, the mood is quite subdued and resigned to the idea that while we may be bottoming in terms of metal price downturns, it could be 12 to 18 months before an upturn turns things around. So it is now this sideways motion with weak metal prices during which bankruptcies are expected. And in fact, some speakers have suggested that bankruptcies involving major mining companies are going to be what ultimately is the trigger for the turnaround of the sector.
Wow, so you're waiting for failures to happen. Of course, the vultures will be circling looking for bargains.
Indeed, the private equity groups are standing in the wings. A handful of them have been quite active already, but many of them are relatively new to the mining sector. They realize that we're dealing with the back part of the super cycle, which has come to an end, and we have the usual oversupply capacity colliding with a decline in demand growth. We also have this issue that China's GDP is shifting away from industrial capacity and infrastructure build-out to more of a consumption-based economy, which is far less intensive for metal consumption than the 15 years from the past period. So they are seeing these assets that the big guys acquired, developed, and that are now underwater due to what will be a temporary downturn in metal prices. They see this as an opportunity to come in, acquire these assets, fix them up just in time for the turnaround in metal prices.
I just saw a forecast for crude oil, and it said they're not expecting any kind of turnaround for at least a year. Do you agree with that?
Well, that assumes that all the various oil producers will be in a position to continue pumping the oil at the current level, and that countries like Iran succeed in stepping up their output now that sanctions are being lifted. What could distort these expectations are geopolitical supply disruptions, such as the situation in the Middle East spinning completely out of control, with the result that some of those ports will no longer be loading tankers with oil to ship to the rest of the world. The other thing people are not really paying much attention to is the nature of American shale oil production, which has very steep decline rates. And America ended up in first place last year in global oil production, courtesy of heavy debt financing to drill these frac wells. And however, by 2016, we should start seeing the effects of the cessation in drilling in the past year start to kick in, and we could see the oil supply in the United States decline, and that would also have an impact on the price of oil.
Right, and how many oil companies are going to go under in the meantime? I mean, small ones, not the big guys.
Oh, a large percentage of them, sort of the mid-tier companies, and the American banks lent heavily to these groups at sub $40 oil. They do not have the cash flow to sustain, to make the payments on their debt. So this is an area where you will see a lot of pain as these debentures, these bonds, these corporate bonds and loans become absolutely worthless. And it is a bit of a game where they have to keep spending money to drill more of these frac wells. It's not like they have found giant reservoirs of oil that are going to pump for 10, 15 years and simply that we go through a period of a weak cash flow. These wells require continuous reinvestment of capital to keep them pumping. So these assets are not really the kind of quality assets that traditional oil reservoirs are.
Is there going to be a brain drain in the oil business with so many people being laid off right now? They might find other good jobs and not return to oil.
I don't think the situation in the oil sector is as severe as it is in the mining sector, where we do have a demographic problem in the sense that a lot of the geologists and mine engineers that are now being laid off, both from the juniors, which played a very important role in the past decade in doing the kind of advanced feasibility demonstration work that this talent is very good at executing. The oil industry has a broader, better demographic because it's always been a very important part of the American economy, whereas mining is a relatively less important part of the economy. In Canada, mining has been an important part of the economy, but we are now seeing an attack on the junior sector coming from the regulatory system, which I think has very negative implications for Canada's future role as a source of talent in the mining industry.
I was just going to ask about the juniors. What are these new financing and regulations going to do?
Well, there is very little happening on the regulatory front that is productive for the juniors. They are looking at liberalizing rights offerings so it is easier to conduct a rights offering. But an unfortunate trend that I already see as happening is that in future, rights offerings will be done at deep discounts to the market price, which will be another form of wealth destruction coming as a result of the failure of the regulators to allow the private placement mechanism to flourish. In fact, one of the very egregious new developments being pushed by the Ontario Securities Commission is an attempt to marginalize the accredited investor exemption. And that has been the main gateway for financing for the juniors through the private placements. An accredited investor is somebody who has a net worth of at least $1 million, excluding the primary residence, or has made $200,000 or more for the past couple years and can expect to continue to earn that in the following year. What they are now requiring is the completion of a questionnaire, which is an incredible invasion of privacy. One has to even detail one's spouse's sources of income. One has to list and describe where one has debts and so on. And the response from people who have seen this is, I am not going to reveal all my personal financial information and give it to a class of people whom the regulators treat as a group of latent criminals. And this has been the message that the regulators have been sending, that all these junior companies that are publicly traded, their managements are all potential criminals, and that we must hover over them and monitor everything they do, regulate everything they do, or they will behave in a criminal manner. And that signal, at the same time, they're now asking accredited investors to share their financial details with this group of latent criminals. This is a complete breakdown of the system, and it can't be that they are ignorant about the implications of this. They are shutting down the accredited investor exemption through this invasion of privacy.
Why is this happening?
There appears to be, in the name of investor protection, a war on the entire concept of owning individual securities. The banking establishment in Canada has set as its goal the management of all Canadian assets. And what they've discovered is that there is a litigation risk if an account happens to own an individual security, say Volkswagen, which suddenly blows up because there was something done by the company or to the company which results in a catastrophic failure of that company. And there is a theoretical possibility that the brokerage firm or the financial advisor should have known about such risks and discouraged the client from owning that stock. Instead, what they want clients to do is put their capital into structured products, mutual funds, index funds, ETFs, where the individual company catastrophe risk is diversified away. And of course, the banking establishment has its fingers in all these structured products, and this is a source of fees behind the scenes, which they collect in addition to the fees that they charge the clients for managing these assets. And the juniors, they are a category of high risk, high reward, which the banks cannot really make much money on because commissions have been deregulated, and individuals buy these things on their own. And if they want to trade these things, they shift away to discount brokerage accounts where the banking establishment does not collect the kinds of fees it gets from managing these accounts. So there is a hidden agenda to simply eliminate Canada's venture capital market so that this problem of capital leaving the asset management fold into these juniors disappears.
I've heard the banks have an agenda that they want 2% of your income no matter what.
Well, that is the old model, but even that model is under siege because robo-advisories are coming along where algorithms basically, based on the profile that you have created by answering a detailed questionnaire about your financial situation and objectives and age and all this sort of stuff, you can algorithmically manage the account so that it always stays in perfect balance with the sort of portfolio allocation that your profile suggests is ideal for you. And once there's no human being in there where you just put your money into the account, fill out the profile, and then away it goes and basically tracks the indexes minus the whatever leakage, competition will drive those fees down to 0.1, 0.2%. And in the long run, these banks are going to become robotic entities where financial advisors, the only role they will play is to get clients in the door, make sure they fill out the profile, and periodically schmooze them on the golf course so that they don't move their account somewhere else. We're talking not just the death of the juniors, we're talking the death of the financial advisor.
And I'm sure they're not very happy about that.
No, the ones I talk to can see this threat coming. They see themselves being squeezed by compliance department. They see litigation liability risk being imposed on them. They can see that they are not going to be in their role as financial advisors for, too much longer.
How is that going to help the client, or does it? It just helps the owner of the bank.
Well, the clients, presumably these robotically managed accounts will probably outdo the stock picking or portfolio picking done by a financial advisor, and you will track the performance of the market indices, which isn't the greatest thing, but it's better than say loading up on say mining stocks in the past couple of years and being down 80% in what were a couple of years ago top quality companies.
We're speaking to John Kaiser, founder of Kaiser Research, his website, kaiserresearch.com. In Canada, the uptick rule was removed. The junior resource markets have had a severe beating since then. Is there any way to improve this, and should that rule be brought back?
Well, the uptick rule was eliminated in the United States to enable traders to arbitrage between structured product markets such as indices and futures and options and so on, and the underlying exchange-traded securities. They need to do these transactions simultaneously in order to capture the arbitrage. It is deemed to be a good thing because it makes markets more efficient, but the existence of the uptick rule made it impossible to really be sure that you weren't violating the rule. So they eliminated this rule. Now, in the Canadian situation, when we're dealing with juniors, there aren't really any indices in which the juniors are part of, and there are also no options that are traded on the juniors. So this argument is not really relevant to the juniors at all. In my view, one should be able to restore the uptake rule for exchanges such as the TSX Venture Exchange, which specialize in junior companies. However, because the exchange is no longer a social good, a public good operated as a utility to facilitate a market for these venture capital companies. It is instead a for-profit entity. The regulator said, well, you need to have some competition. So all these other entrepreneurs who are developing order execution platforms similar to what the stock exchange operates, they will be allowed to set up parallel to you, and the financial industry will be required to pursue the best order or the best fill for their clients' orders through all of these platforms operating side by side. Now, when you have something like that, and you have orders coming and going from all directions, it becomes very difficult to establish what is the most recent price and determine that, yes, this price is indeed not lower than the last different price. And so we have now, they cannot restore the uptake rule as long as we have this fragmented system of multiple order platforms which brokers are required to feed their orders into, and they usually do so based on calculating the various fees for the different platforms, fees that, by the way, savings on they do not pass on to their clients. They pocket it for themselves.
Well, that doesn't sound very healthy for the investor.
No, and the real problem, though, is allowing certain clients to have day trading accounts which do not have to borrow stock in advance. Now, in the Canadian system, shares can only be made available by the broker for borrowing by short sellers if they are an account that is a margin account. In other words, the shares in it are being borrowed against to buy other shares, or it is in a segregated cash account that has an outstanding balance that is beyond the 3-day settlement date. When that exists, the brokerage firm can simply take that stock and lend it to whomever wants to sell a position short. And the reality is that most of these accounts that hold junior stocks are not margin accounts, and compliance departments are pretty sticky about making sure that clients pay up for any purchases that they have made. So theoretically, none of these shares should be available for borrowing, and it is actually quite difficult to short sell junior companies in the traditional sense of where you decide a company is overpriced and you borrow stock and you go short with the expectation that the company will end up being eventually valued at its proper lower price. Instead, what we have now is these day trading accounts where you do not have to borrow the stock, because these day trading accounts have to be flat by the end of the day. And it is in these accounts where the downtake rule is very damaging to the market's role as a price discovery mechanism. So now you have these professional traders, often using computers, monitor the system for incoming capital, and they can literally intercept these capital inflows, these orders, and sell non-existing shares to this order flow, which is usually triggered by some encouraging news a company has published, or maybe some newsletter writer such as myself has said some favorable things about this company, and this has spurred an inrush of buying. And once that inflow has exhausted, these short sellers, of course, need to cover the position by the end of the day. So the rules are now structured so that they can continue to sell and hit the bids in the order book and basically paint the tape with a downtrend that has the effect of discouraging all the legitimate long shareholders that, well, that was a short-lived rally. I guess the news is not as good as it appeared to be. I think I'm just going to give up. And so they end up blowing out their position, which may have been bought at a cheaper price, some time ago, but they give up on the company. And of course, the short sellers are there covering their short position by the end of the day. And the net effect is this capital stripping mechanism where these traders, without contributing anything of value to the market as a price discovery mechanism, are siphoning off any sort of capital that flows into it. And this is creating a downward bias for these venture capital companies which lack an easy means to be valued by the market.
How important are the junior resource markets to governments in their ongoing quest for job creation and tax revenue?
just the sort of 1,200 or so TSX Venture listed juniors, which are in the resource sector, in their past fiscal year, their general expenses category, which would be money not spent on exploration but spent on conferences, on marketing, on lawyers, on legal, on the exchange fees, regulatory fees, and all this sort of stuff. This was about $800 million, of which a significant chunk, more than 75%, it comes from companies that are based in British Columbia, namely Vancouver. So this revenue flow, which is basically dispersed risk capital that goes into these treasuries and gets spun out to all the support industry, this capital flow is in danger of evaporating with the current situation. And this doesn't even speak to the money spent on exploration, which employs technicians, assay labs, drill contractors, all the parties that are involved with looking for metals. And a good chunk of this money gets spent in Canada, so it doesn't just flow out to Peru or other parts of the world. And a further problem that I see happening with the extinction of the junior sector is the juniors are the home where the majority of people who enroll in geology, geosciences, and so on end up getting a job. And by reducing the system to a handful of very good juniors and then a handful of majors, you really undermine the will of people to sign up for a geology degree. And it's a statistics game. If you only have a small group of people enrolling because there is a small market for these types of workers, you're not going to get the cream of the crop that the Canadian system has historically created, where lots of people sign up for this program. The very best end up being picked up by the mining companies or the very sophisticated, well-financed juniors, and the rest end up having a future working with these smaller juniors, which some of them occasionally come up with a big wealth-creating discovery. So I think Canada's future as a spawning ground of mine engineers and geologists that are world-class is in danger.
Is there anything government can do about it to prevent that from happening?
The most important thing that I think that has gone wrong with the junior sector is the ability of the juniors to efficiently raise capital. The brokers are disappearing as an advisor that steers people into these juniors. They are no longer doing any meaningful financing of any sort. The accredited investor restriction has reduced the pool of capital available to the juniors to a minority that qualifies for this $1 million wealth definition. And even that exemption is now under attack by this privacy invasion requirement that the regulators have launched. In my view, they should accept that they've done a pretty good job regulating the disclosures of the companies and regulating the markets to make sure there is no cheating from insider trading and all that. And they should allow anybody to invest in private placements, put money into the Treasury. Canada has only a 4-month hold restriction, which is not onerous like the 12-year hold restriction in the United States. They should do away with this nonsense that only very wealthy individuals should be allowed to fund high-risk, high-reward juniors. Make the flow of money easier into the treasuries, and then let the market determine which companies deserve that capital.
Well, you talk about high risk. If you invest in the lottery, for example, your odds of winning one lottery in Canada, the 649, are 1 in 13 million. And if you go for the Lotto Max, it's 1 in 43 million. They allow you to do that, but they won't let you invest in a junior mining company.
Yes, I mean, buying a lottery ticket is, the odds are so poor that it's basically voluntary taxation of a class of people who can least afford this. They're allowing these people to dream that they can escape from their current economic situation by giving away a portion of their personal money. Now, people do not invest huge amounts in lottery tickets, so you can argue, okay, this is their little thrill for the week to go down and buy these lottery tickets and see if they finally got lucky. However, the juniors are more comparable to a casino. This is what they should be functioning at. Now, the financial sector loathes calling anything that they're involved with a casino. But even when you look at with these bonds that these financial groups have peddled in the past year, bonds that are down 75% from their face value because of big macroeconomic changes in the world that have put companies' cash flow or hurt cash flow substantially, and these debts can no longer have their interest covered, and so on. Everything is ultimately a gamble. And what they really should do is accept that the juniors represent gambles that aren't just a reshuffling of existing wealth the way an official casino operates, but that what it is, it's a pooling of wealth from many, many corners of the world and funneling it through entrepreneurial activity engaged in by the company that can create new wealth in the form of new discoveries, new mines, and of course even beyond that in technology and bioscience products and so on. All of these are high-risk, high-reward ventures, and to invest in them is not really to invest in them, it is to place a bet on an uncertain outcome and hope that it all works out in your favor, and you accept that if it's a high-risk, high-reward bet, you probably will lose your money in that process. But unlike casinos where you have to place your bet and then you're stuck with wherever the ball rolls up, in a market such as what the juniors have, you could see success appearing to happen, and you would see an increase in the market value of the company, and you can choose to remove your bet and take your profits and place the bet elsewhere. And that's how the public venture capital markets are like a casino, but superior to a casino.
We're speaking with John Kaiser, founder of KaiserResearch.com. John, are there any particular areas that you might be optimistic in the mining sector?
Well, if you're willing to be patient for 1 to 2 years, all the metal prices will be higher than they are now. I look at the 600 or so economic studies that the juniors have done in the past decade and spent billions of dollars doing. When I run these economic studies at the current spot prices, almost every one of these projects is worthless. And even the big mining companies that have invested in major mines, at current metal prices, many of those projects are also underwater. What this means is that in the medium term, these metal prices are not sustainable. These low metal prices are partly due to an oversupply created by the response to the China supercycle, but it is also a result of a lot of metal having been financialized as a type of hard asset and has been used as collateral for loans in China to speculate on their real estate or stock market bubbles. And all of these speculations are now coming unglued. Metals are now being definancialized. You look at platinum down at $850. Why is that? Has demand for platinum collapsed that much? Has there been that much build-out of platinum oversupply? Well, there has been a distortion in the market due to ETFs, which have bought the metal, and they've been peddled to people with as a sort of a bet on the U.S. dollar collapsing and so on. And that bet has gone wrong. And so now you're seeing an exodus of gold, platinum from these various ETFs that is hitting the market at a time when the traditional end users for these commodities already have their fill, and they're just standing back and letting the prices plummet. Once all this metal has been pushed out of the warehouses and all these complex carry trades that entities like Glencore have in place and that have been caught wrong-footed or unwound, we will see metal prices bounce back up. So going into the sector and looking for companies where you can see their ability to survive and not end up being bankrupted because they have some huge payments coming due or have debts that somebody else owns, loans that's going to result in them owning the company at the expense of the equity shareholders. This is a good time to look at that.
Where do you see the most and least political risk for the miners?
I would say that we're going to see a trend of returning to safer jurisdiction. This commodity downturn is causing severe stress in many of these emerging market economies that are dependent on raw material supply. These countries are going to suffer strife as a result of having to cut back on whatever social programs they have. Even Saudi Arabia is going to discover that its effort to blow up other nations and big projects in the U.S. shale oil industry is going to discover that it may have internal problems arising from the lower revenues created by sub-$40 gold. Countries like the Congo, which supply high-grade copper, the instability that's already there can only worsen. So I see a high risk of supply disruption from mines that are actually quite profitable and are not going to be the ones on the chopping block as the industry deals with its overcapacity. And this is a sort of an outside chance that we could see metal prices rebound faster than they would if the world continues to operate in a normal manner.
Governments are focusing on climate change right now. What kind of opportunities do you see for the resource sector there?
The push for higher energy efficiency and alternative forms of energy is going to stimulate demand for some of the more obscure metals, the so-called critical metals. For example, one metal that has not received any attention historically is scandium, which is the perfect marriage partner for aluminum. You alloy it with aluminum, and it extends aluminum's functions in extraordinary ways, makes it stronger, makes it corrosion resistant, makes it able to be welded with a joint that's as strong as the material itself. And everywhere where you have anything that moves and consumes fuel, there is a desire to use lighter and stronger materials so that the vehicle, whether it be a car, a train, a boat, or an airplane, can be lighter without sacrificing any safety issues or anything like that. So all of a sudden we're going to see this metal, demand for it, go through the roof, which of course has not been possible in the past because there have not been high enough grade deposits known in the world. And this is a story similar to niobium in the 50s. It all came as byproduct from various alluvial operations, and you couldn't really do much with it, but niobium is an ideal marriage partner for steel. But when the big deposit was discovered in Brazil called Araxá, and a couple others such as the Niobec deposit in Quebec, all of a sudden it became possible to produce niobium on a primary scalable basis, and a small $20 million a year market has blossomed into a $2.5 billion market today. So you look at metals like scandium, where these deposits have been discovered in Australia that are 4 to 5 times higher grade than other deposits with scandium in the world. You can see a whole new industry blossoming. You could see a junior exploration boom happening as companies look at these pegmatite systems all over and check the assay sheets. What was the scandium grade in that metal? And we could have like a mini boom similar to, say, when diamonds were discovered in Canada in 1991, and suddenly everybody was looking all over the place for diamonds that they hadn't really thought were something that could be found in a country like Canada.
If you're in charge of the junior markets in Canada, what would you do to help junior companies get prepared to take advantage of higher metal prices when they happen?
Well, right now, I think the focus of companies should be exploration. Rather than wishing metal prices to go higher and waiting for that to happen, something over which the companies have no control, they should rethink the geology of their projects or the geology of different areas with which they have familiarity and ask themselves, is there potential to discover a deposit that works at the metal prices that we have now? And can we raise money to test our theories and demonstrate, yes, there is a deposit here that works at current metal prices, and if we do get the recovery in a couple years, it will work even better. Unfortunately, this is the highest risk segment of the junior discovery exploration, in which institutional capital has no interest. And because the markets are no longer liquid and no longer function as a proper price discovery mechanism, the accredited investors are reluctant to put in the seed capital to start these exploration programs, because they do not get that reward in the market where if you start finding something that looks like your hypothesis is becoming reality, you can finance at a higher price. You can do grassroots exploration, but grassroots exploration is going to be problematic because almost every outcrop has been hammered and investigated. If you're going to find significant deposits, they are going to be blind deposits under barren cover, under gravel, under overburden, and so on, which means you probably need to add the drill rig to your exploration tools in generating a target. But perhaps the most productive way for juniors is to look at the systems that they already own that are worthless at the current metal prices and ask themselves, have we really understood what this system is all about? Is the metal budget accounted for by what we see, and is this thing hopeless unless metal prices go up? And a good example would be the Oyu Tolgoi project that Ivanhoe acquired from BHP in 2002 in Mongolia. It had this open-pittable copper resource that really didn't work at the metal prices at the time. However, through exploration of the system, they discovered the Hugo Dummett zone, which was substantially bigger and substantially higher grade, and is now the basis of a major mine development. It is not open-pittable. It is an underground blockading operation, but it was the geologists rethinking this system and figuring out where the payload really ended up, and then exploring for it. This is what the juniors should be focusing on, putting all their geological ingenuity to bear, compiling the data, using the latest digital technology to run simulations of this stuff, and then put forth a program proposal to the public, to their audience, and say, here's what we think is potentially there. Will you give us money to test this thesis?
John, how can we find out more about Kaiser Research?
You go to kaiserresearch.com, and there's a number of links on the homepage which are self-explanatory. For example, if you want to see recent presentations, you go to the conference speeches section, and then of course there's a link called General Release Schedule, which shows when restricted material is available to the general public without needing a membership to Kaiser Research Online.
John, thanks a lot for chatting with us.
Jim, thank you very much.
My guest has been John Kaiser, founder of KaiserResearch.com. That wraps up our show for this week. Thanks to our guest, John Kaiser, and thank you for listening. Any questions or comments about the show can be sent to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.